thank you for joining us on this wet Sydney evening. I appreciate you braving the rain for us. For those that don't know me, my name's Steve Maarbani. I'm a corporate lawyer and I was a former PwC partner. I was at PwC for 10 years and towards the end of that time I ran the venture capital practice. That practice gave me the privilege of working with some of Australia's leading VC funds, establishing those funds from scratch, working with the funds management team on the investment processes, and of course being part of the due diligence for some of the investments that they made. But all of that started right here. The Sydney Angel Sidecar Fund 1 was the very first venture capital fund I ever worked on as a senior associate at VentureCrowd, at PwC. And so I have a real fondness for this brand and the work that it's done and the people behind it. Sydney Angel Sidecar Fund 1 was conceived at the locomotive tram sheds in Everleigh on a very cold winter's day over our egg and bacon rolls on a Friday morning when the management committee would meet to work out how to grow Sydney Angels. And it was a beautiful collaboration between an angel group and a fund manager. And the idea was to bring to the offering the strengths, the respective strengths of both, in order to open up the private capital markets to a broader group of people, to facilitate a larger pool of potential capital, and to enable a new set of investors to have passive exposure to a diversified, highly curated, well-assessed portfolio of early-stage investments, and benefit from the high growth that you can only get from a well-executed investment strategy into early-stage companies. There is no other way to obtain the kinds of returns that an early-stage investment in a company that goes on to become a unicorn can possibly give you. So, and that theme of opening up the markets, democratizing it, making it available to more people, is very dear to my heart. And it was the thing that led us to establish VentureCrowd, which is where we looked at that same challenge and asked, what if we could digitize it? What if we were able to digitize the private investment process so that both the capital raising side and the investment side was done online, opening it up even further to even more people to be able to invest in early stage startups, 3 clicks and you're done. Sounded like madness at the time. It's now works pretty well. So since we started, we now have 76,000 registered members, 3,500 wholesale certified investors who've invested over $330 million across 150 projects, returned income distributions of over $25 million across a bunch of income funds, and achieved venture capital exits of up to 295%. And we're just getting started. So tonight is particularly exciting for me because this is a bit like coming home, coming full circle. So I'm super, super excited, and I know that the VentureCrowd team who's here tonight is equally excited to be partnering with our very good friends at Sydney Angels to bring the deal origination, curation and assessment process that's been developed by Sydney Angels over more than a decade and match that with the funds management and digital investment platform capabilities of VentureCrowd to bring you Sydney Angels Sidecar Fund 3. Now, today what we're going to do is I'm going to hand over to Adrian in just a moment. He's going to talk you through Sydney Angels. What is it? How does it work? How does the investment process work? Why is that investment process so compelling? And I do genuinely believe that it is. Then we're going to hear from some founders who have had the benefit of investment from Sydney Angels and from the previous sidecar funds. And then I'll get back up and talk you through the fund itself, high level, and the opportunity to participate in the first tranche of this raising. And then we'll take some questions. We'll turn the music back on. You can have a drink and meet some cool people. So there's no need to rush off immediately. And just before I hand over to Adrian, I would like to provide you with some very brief, but I think important context, the macroeconomic factors that I think are relevant to everybody who's in this room, to this fund, and in particular, the timing of this fund. And I start here. When you unpack the data on the public and private markets over the last decade, what becomes very clear is that the investment markets are undergoing one of the most significant shifts from public to private. The private markets are at the fastest rate of decline in 25 years, according to JP Morgan. You used to list because you wanted capital or liquidity, but now the volume of capital that exists in the private markets is such that you can get both without ever doing that. It used to be the case that if you're looking for diversified exposure to the national economy, the listed markets were the place to go. But that's no longer the case either, because the indexes that are most represent a diversified portfolio are actually driven and reliant upon 2, 3, 4 key companies for their performance. What you don't get anymore with the listed markets is what you do get in private. And what we're seeing is, and these aren't my statistics, that while the global equity markets are continuing to drop, while more and more companies are choosing to stay private, while more and more companies are not being represented on the listed equities markets, and therefore the listed equity markets no longer properly reflect the true universe of investable corporate stocks. So if you want that, you have to go private. And we're seeing that trend in the numbers. The private capital markets have grown from 1.6 trillion in 2005 to 13 trillion in 2023, forecast to continue to 21 trillion by 2030. But I think that is quite conservative. There are a couple of reasons that are relevant to this group and this offering, which drive those numbers. And we could talk about this for hours. I won't. Just a couple that I want to point out really quickly. The first is, we are currently in the process of the largest intergenerational transfer of wealth in history, with trillions of dollars already transferred and being transferred to new generations, to the next generations over the next decade. And what that means is financial power, investment power, financial services market power is now shifting to a brand new group of people. That demographic, that new demographic, that younger demographic is becoming the most important financial services customer in the market. And in my view, the most important investor group on the planet. And the way they invest and what they want to invest in and how they invest is very different to how it was done a decade ago and even 5 years ago. And that will continue to change. That thematic is relevant here. Secondly, digitization. I don't have to tell anybody in this room about the importance of and the value to be created by digitization. But even in the investment markets, the digitization of private capital markets, the digitization of the investment markets is such that now, if you've got a phone, you've got access. And that wasn't always the case. Now you can invest in startups in 3 clicks on your mobile, on the bus, on the way to work. You can invest similarly in the Sydney Angel Sidecar Fund the same way by using that QR code. Now, I am a technical Neanderthal, and even I can do it. And I tried it this afternoon, just to be sure, and it works. So digitalization is expanding access. And both of those two thematics mean that are driving the third one, which is that the alternative assets markets, adoption of alternative assets, is now mainstream. It's no longer the case that alternative asset growth is being driven by only institutions in the top end of town. Now, alternative assets are being demanded. Private assets, shares in private companies, the kinds of companies Sydney Angels originates and invests in, the kinds of companies this fund will invest in, those assets are now being demanded by more and more people across the spectrum of investors. And I'm not just talking about individual wholesale investors, I'm talking all the way down, emerging affluent, mass affluent, all the way down to retail. That is what the figures are showing. And so, if this redirection of capital is fundamental and not yet finished, then this has a way to go. And for all of those reasons, this fund has been created. This fund has been created to address those exact thematics. This fund has been created to to respond to that exact demand for private market assets passively into a curated portfolio of deals that have been originated, assessed, and invested in by a Sydney Angel syndicate using a playbook that has been developed and refined over a decade into a tax-free fund for as little as $25,000 called over 5 years. That's $5,000 is your entry price, done digitally. So everything we're about to tell you is a direct response to what we're seeing in the market and when we're seeing the demand. I was speaking to my friend Owen, with Owen, just there. And without any prompting, he basically gave me my intro. Right? He's a partner at a law firm. He's interested in technology. He doesn't have the time to do the DD, but he knows there's growth here, and he wants access, passive access, by people who know what they're doing without him having to think about it. That's exactly what this is. So we'll come back to how you participate in a bit, but for now, over to Adrian.
Can you hear me okay on the back? Yep, thank you. That's actually a hard act to follow, Steve, so thank you very much. I'm very proud of Angels and the Sidecar Fund free for people. There are a heap of people in this room who know what angel investing is. There's a group of people who don't know what it actually is. I'm going to give a really super high level. I'm not going to go through all of them, but for those people who aren't aware of what really it is, angel investing is investing at the very, very earliest stages of when a company is being formed, sometimes with the family and friends, and sometimes straight after that family and friends. It's normally the first amount of external money going into a company where that entrepreneur, founder, needs to go and convince someone else to give them their hard-earned dollars to put into the company. One of the things that angel investors do, why do they actually do it? It's actually about backing innovation. It's about backing that company who's going out there trying to create something new, create value for their customers, create more jobs, and actually innovate and do things better than what the competing products are actually doing. There's a huge amount of economic and societal benefits as a result of doing it. Yes, when I do angel investing, I like to make money. Like everybody who invests wants to make money. But I get a kick out of knowing that I've helped the business go out there and create jobs, improve things for society, improve things for customers, give them cheaper products, give them better products. So all of these things come together about what you're getting out of angel investing. This is all about Sydney Angels Sidecar Fund 3. It relies on Sydney Angels. So what is Sydney Angels? Sydney Angels is a member-based organisation targeted for angel investors, helping them to invest together in startups. It's a team-based approach. We don't do this thing just by ourselves. We work together as a group of people to do it. What we look to do is help people efficiently source deals. We give an entrepreneur an ability to come in with one application and hit a large group of people, so it's a really efficient use of their time. And then those members also get to benefit from the fact that deals are coming in because there's an attractive basis. We also like to hope that having a group of people means you make better decisions. It's not me as a single person with my expertise trying to make a call on what happens, whether or not this is actually good investment. I get to rely on other people who have got much, much deeper and better expertise than me in their various fields that they've got. That then doesn't just stop at the time of the investment, it actually continues after the investment's been made and you get access to networks. So there's a group of people that you can go in and ask for help and assistance if you've got a problem with one of your companies or you need to get an introduction. One of the things we all probably know is Australia's a small place. Sydney's a really small place. And within about 3 or 4 phone calls in a decent group of people, you can probably get to almost anyone in Sydney if you actually need to. So that power of that network is really, really strong. The other thing we actually do for angel investors is we actually help them become better investors. We get them to liaise with other investors. We do training sessions. So the whole point is, after doing this for a decade, actually I think we're coming up to 15 years now, that you're actually getting a collective value of the experience that actually comes through. So what's the process that Sydney Angels actually goes through when it's actually doing it? How do we get the deals that are going to ultimately come into the Sidecar Fund? Throughout the entire year, at any point in time, an entrepreneur can make an application into Sydney Angels. It starts at the top of that. So new deal applications at any time. 6 times a year, we effectively do what we call a deal screening meeting. So we're filtering those applications as they come through. So at each point in time when we come up to a deal screening meeting, anywhere between sort of 30 to 50 companies have actually applied through that particular process. You have a committee and a deal team who reviews those ones, and they rank those deals to what they think are the most interesting deals that are potential angel and backable deals, and we come up with 6. So you go from 30 to 50 down to 6. Those 6 companies then pitch to a group of investors at the deal screening meeting. That's normally sort of 10 to 15 to 20 members who will then see each of those companies do a pitch. They do a 10-minute presentation, they do a 10-minute Q&A. We then rank and score those ones, and we rank those to what we think are, we actually rank them 1 to 6, and we collectively form a view on what we think are the 3 best deals out of those that are of interest to investors. Those 3 deals, 2 weeks later, then go and pitch to a members meeting, which has normally got 40 to 50 people. Now, we used to do them face-to-face when we started. We now do them via Zoom. You then have that members meeting. Syndicates then form around those deals. Normally, most times, all 3 companies have enough people say, yes, I'm interested in learning more about that particular company. Sometimes, one of them doesn't grab a huge amount of attention. It's pretty rare, but generally it's 3. We then get a syndicate of people, so you might get 5, 10, 15 people who say, I'm interested in learning more about that particular company, and they start doing due diligence on that company. They then work on that as a group, meet with the company, and start actually working on what are the key risk areas, what are the things we like about it, where's the opportunity, how do we validate the market, do we go and talk to customers? This is all done on a team-based approach. So you've got 4 or 5 members who sort of lead different streams, supported by others in the network. They then keep working. This is normally a process that takes sort of 6 to 8 weeks to go through and do that due diligence, and then they form up and say, yes, we like this deal. They start negotiating it. They then ultimately make an investment in the company if it goes through all those things. To date, there's 91 companies that have been through the Sydney Angels portfolio as at end of last month. So you'll see this consistent one that actually goes through and it just continues on. I'm not going to talk through everything on this slide, but what this effectively says, it sort of describes parts of what I've done through that process. So that first 1 month is the screening process, 1 month for the deal selection and starting the DD, and then 1 to 2 months for the more detailed due diligence and the negotiations. This is where the Sidecar Fund then gets involved. So once the syndicate has actually started saying, yes, we really like this, we understand the process, we understand what the deal looks like, they then approach the Sidecar Fund investment committee and say, this is the work we've done, these are the deal terms, we think we want to do this deal. The investment committee will then ask some questions, understand a little bit more. They'll be following along, understanding the due diligence that's been done, and they provide feedback to say, yes, we think this meets the criteria, and we'll talk a little bit about the criteria later, and we're going to co-invest alongside it. If it goes through that full process, the Sidecar Fund then co-invests and matches those angels, literally dollar for dollar, up to about 250 grand, because you need to sort of balance diversification around it. Then the investment's actually made. Then you've got to then do the post stuff after. Now, the power of the Sidecar Fund is that the people who have helped make that investment decision, they've done the DD, they've then put their money where their mouth is by investing in that. They then stay involved with the company through to the exit timeframe, tapping into the different resources that are available in the membership base and in the investment syndicate. So over the next 4 to 10 years, you've got active management involved in helping that company achieve the best outcomes, supported by the Sidecar Fund Investment Committee. This sort of just shows, here's the applications. The big blue bars are all the companies that applied and got screened out on application and didn't get through to that final stage. So the hurdle rate is pretty high, and it's very, very hard to get through. I mean, there's a group of companies in there that are pretty average, and it's pretty easy to screen them out. But there's a lot of good companies in there as well. You'll see it sort of bounces around that sort of 200 odd applications a year, sometimes a little bit higher, sometimes a little bit lower. And then the smallest bars, the little green bars, are the companies that actually get invested in. So there's a really rigorous process that goes through that. Now,